Stephen 18, Aalto Invest. Stephen, could you say a few words about what Aalto Invest is doing?
Yes, well, Aalto Invest is one of the newer non-bank financing platforms in the market. We have a 700 million commitment from a collection of European pension funds to build a senior debt platform across Northern Europe. So that's sort of 0 to 65% loan to value financing. We've probably put about 250 million to work already of the 700, and probably have a pipeline of another 250 million fairly close to signing. So we're making quite good progress. And most of that's actually been in the UK market today, although we are looking at the Netherlands and Ireland as alternative prospects too.
The big issue today seems to be the availability of assets. What's your take on the UK property market?
Yeah, it's definitely got more competitive. I think our clients are finding it harder to find good opportunities, and that sort of flows into the debt financing world too, where opportunities can become harder to find. So I think there's market's more difficult in that respect, but it's also more positive in that it's another step down the recovery path. So we're still expecting, you've just seen some major sort of NPL transactions done by the IBRC, and that's an indicator of the future flow of products coming to the market too. So we still think the financing markets will be pretty busy in 2014 and 2015, and they're obviously evolving now. So in the UK, it's definitely moved broader into the market than it was probably 12, 18 months ago. But no shortage of opportunities overall.
Looking at the asset values in London, probably outside London, is that something that concerns you?
We're cautious on super prime residential in London, but I think that apart, most markets we feel are fairly priced. I think we're expecting to see good rental growth in sort of grade A offices in some of the regional cities. We've had a 4 or 5, 6, 7 year period now of actually relatively low building in commercial markets. So there are certain markets now quite prime for rental growth, I think. So I'm overall not overly concerned, apart from perhaps the super prime London residential values. I think they may have be approaching their peak, but that apart, I think the market's fairly well priced.
Mm-hmm. Would you say the UK lending market is in a healthy state?
It's probably more advanced than most of the other markets, I think, in terms of its recovery, and the fact that there's new non-bank money coming into the market is a positive for the market. It's a much stronger base from which the market can operate. And if you compare the UK to markets like the Netherlands or Ireland, which are still very short of debt capacity, then actually it's very well placed. But yeah, the UK is probably the most liquid and broadest real estate market in Europe. So in a way, you expect the recovery to start in the UK and to gradually move out to other countries in time.
So someone said it's disturbingly easy to exit financing, to access debt in the UK, which is true on probably on some products, which is not true on other products, new developments, etc. Is there generally a supply-demand mismatch?
Well, it's different in different pockets of the market, I think. If you've got a well-let central London office building, then there's a lot of debt capacity chasing those types of opportunities, and pricing gets more aggressive month by month. But if you move into other parts of the market, other sectors of the market, there's far less capacity. So I think it depends very much on what part of the market you're actually working in.
You mentioned it yourself, you're raising a fund, or you have raised a fund, you're also lending. Which one is the more challenging side of the business right now?
They're probably both equally challenging. I think there's a lot of interest amongst insurance companies and pension funds to enter into the real estate debt financing market. They want to do it with a manager they trust. They need to build up their knowledge levels and their experience levels to gain confidence. So there's a sort of education and gradual evolving process there. But I think as a fixed income alternative for those investors, real estate debt is still quite compelling, and should remain so in the future. One of the challenges for a new non-bank platform is to also prove that you can originate transactions, and therefore getting your name into the market and getting known in the market and building a reputation in the market is a process which takes a bit of time, and you have to build up track record and credibility. So in a way they feed each other, because having raised the 700 million, it was important for us to prove that we could actually originate transactions and invest that money wisely. And the more we succeed on that front, then the more money will flow too. So it's a sort of virtuous circle after that.
So the market has become very competitive, you said it yourself. What products, assets are you looking for right now? What are you lending against?
Well, I say the market's competitive, but it's competitive in parts, and in other parts it's less competitive. We've done a lot of transactions on sort of grade A office buildings, which have been sort of partly let up and have a let up strategy behind them. That style of financing has been very well received by the private equity investors who've been looking for that type of product. So we can be very quick to respond to those types of opportunities. We can move very quickly to close a transaction. We can take a little bit more property risk than a bank can in certain situations. And we have a very experienced team, so the client has that benefit of working with a very experienced partner too. So even in a competitive world, you can find ways to compete. And the markets have also, in my view, dumbed down a bit over the last sort of 6 or 7 years, therefore just relative sort of customising transactions to a client's requirement is easier for us with a pension fund investor who's taken hold rather than a bank who's looking to syndicate debt. So we can try and customise transactions to specifically suit a client. And one example of that is, as they let up the building, we can advance further funding against that let up strategy. So the transaction can stay live with the client's business plan, which prevents them having to refinance 2 or 3 years down the line. So there's a number of ways you can compete, but the market's definitely more competitive than it was 12, 18 months ago, but there's still plenty of opportunity for lenders like ourselves.
Stephen, thank you very much
for
that. Yeah?